Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here's the starting lineup for your 3 in 10 podcast for Friday, August 22nd, 2025. Number 1, Jackson Hole recap. Jerome Powell validating a September rate cut. Number 2, retail earnings. I listened to Home Depot, Target, and Walmart. What I found was boring, low growth, but the consumer's okay. Number 3, in the economic data this week, the S&P Global U.S. Flash PMIs were the most interesting data point, showing strength and pricing pressure to the upside. So let's go back to number 1, Jackson Hole. The most important sentence of the entire speech was contained in the middle of the first paragraph. The balance of risks appears to be shifting toward a weaker labor market. So the Fed's been fighting inflation for the last 3.5 years. Now it's turning its attention more to the other side of the mandate, which is the labor market. Powell cited major changes in 2025. Number 1, import taxes, otherwise known as tariffs. Number 2, very low immigration. Both of these are challenging both growth and inflation. GDP has slowed from 2.5% in 2024 to 1.2% in the first half of 2025. He cited that higher tariffs have begun to push up prices in some categories of goods and services, and that will tie into what I learned in retail. Core PCE is currently resting at 2.9%. That's up 0.2 from a year ago when it was at 2.7% when he last took the podium at Jackson Hole. Powell went on to say it will take time for tariffs to flow through, to understand the long-term impact, to understand if workers are demanding wage gains because of tariffs, whether it will have secondary consequences, whether the inflation will be longer lasting as a result of these import taxes. He went on, as he always does, to mention that inflation expectations remain anchored. I don't really agree with him in total there. They're anchored, but they're anchored around 3%, not really that close to the 2% target. This, I think, was the second most important quote in the entire speech. Risks to inflation are tilted higher, and risks to employment are tilted lower. In other words, stagflation is the main risk. And it's almost as if financial markets completely missed that. But I thought it was very important because it's actually playing out in the economy. So policy is currently in restrictive territory. We agree with that. And so Powell thinks that he can afford a 25 basis point cut in September. And sure, I think that's probably right. Cutting rates, here's the hidden political message, I think, is that cutting rates will relieve some of the political pressure that has just been pounding the Fed since the beginning of the year. The most important thing for any Fed chairman in their legacy, beyond fighting inflation and being successful in maintaining price stability, is that the institution must preserve its independence. And that is increasingly in question. Even this week, the threat to fire Lisa Cook is yet another shot across the bow at the Fed. And I think cutting rates, even by 25 basis points, whether it's justified or not, relieves some political pressure on the institution. I would say in total, after listening to the presser and reading the speech, we should not assume that we're kicking off a big rate cutting cycle with inflation creeping higher. Beth Hammack of the Cleveland Fed came out yesterday and said, absolutely not, we should not be cutting. And I think if you're focused on inflation like she is, that's justified. Powell reiterated at the end of his speech that 2% is the inflation target. Now, the Fed has missed its inflation target for 5 consecutive years. I don't know how it can be the target if you miss it every year for 5 consecutive years. I've been maintaining for a while on this pod that the real target is 3%. Otherwise, you wouldn't be cutting rates at 2.9% core PCE. So I think that's pretty obvious, but he's got to say that it's still 2%. Now on to retail. So I listened to calls from Home Depot, Target, and Walmart, 3 of the biggest companies in the sector. There's just not a lot going on. I tried to suss out some interesting things from these calls, and what I found from Home Depot is that they just claimed that the housing markets are frozen. It was a boring quarter for Home Depot. Low single-digit comp growth, very low single-digit sales growth, earnings growth. There just wasn't a lot there that was really impressive or all that exciting. But they did say that their core customers remain healthy due to strong employment, income gains, significant home equity, and of course, gains in household wealth from housing prices going up, equity market prices going up, and even this year, bond prices, heaven forbid, are also going up. Target, they spoke on tariffs, and I thought it was interesting that most of the tariff costs are behind them, and they'll have more favorable comps in the second half as a result. Second quarter comps, though, were down 2%. And Target is taking price increases, but only as a last resort. They're using other strategies to mitigate tariffs, things like AI efficiencies, buying from other countries that have lower tariffs, mix of apparel away from the countries like China that have the really high tariffs. So they're responding, and we know how great U.S. large cap corporate managers are. They are fantastic. And on to Walmart, they projected fiscal sales growth of 4.25%. Well, I'd say to the management, nominal GDP is going to be up 4.25%. So that's really not that impressive. Walmart is seeing the strongest growth in the upper income households. That's also not so surprising that the upper end is doing well, the middle income is kind of middling, and the low end is really struggling. And that has been the case for years. Walmart said that they get less than a third of their goods from imports. That kind of surprised me. I thought they got 2/3 of their goods from imports, but that's not the case. The major places where imported goods come from are China first, Mexico second, India third, and Canada fourth. Those are their largest suppliers in order, and those are also the countries with the largest tariffs. Yes, that makes sense. Walmart is also trying to minimize price increases despite tariffs, and they highlighted their back-to-school prices are flat year over year. So the bottom line is that retail is adjusting to the new trade realities. The consumer is okay when you look at it in total, and there's just not a lot of growth in this sector right now and probably never will be. And I wish somebody could please tell me why Walmart trades at 37, 38 times forward earnings for basically what's nominal GDP growth. Just can't understand that one. Now, on the economic data, there was an interesting piece in what was a very slow week of data releases with all the focus on Jackson Hole. The S&P Global US Flash PMIs came out, and they showed strength, underlying strength in business and pricing pressure to the upside. So the manufacturing PMI printed 53.3 versus an estimate of 49.7 and a prior of 49.8. That is the strongest PMI since May of 2022. That's over 3 years. So that's an outlier. That's a big beat. And it was done on stronger demand and on inflation pricing pressure. New orders hit the highest level since February of 2024. And the survey pointed, when I read the survey, it pointed to resilient demand and optimism toward the U.S. economy in the second half of 2025. A composite index of sales prices matched a 3-year high. So it's basically prices paid at a 3-year high, very much like the Philadelphia Fed, which was reported yesterday and showed very high prices paid. So, in the context of what was said at Jackson Hole, this inflation issue, especially in services, does not seem to be going away. Strong demand is supporting the service sector and pricing power in the services sector. And when we look at whether it's the CPI, the PPI, core PCE, supercore, whatever we look at with respect to inflation, it's services that are driving inflation higher. And tariffs are increasingly being passed along to consumers. That's what we read in the PMI. And basically, these data do not support the Fed easing in September from the standpoint of growth, employment, or inflation. So that's very much at odds with what we heard at Jackson Hole. And, to recount this whole thing today, number one, the Fed will be cutting in September by 25 basis points, but don't assume more cuts unless the labor market continues to soften. Number two, major retail earnings were drab and boring. They're managing tariffs. The consumer's okay, and the stocks look expensive relative to the growth that they can produce. And number three, the flash PMI suggested that the economy in the U.S. is solid, that inflation risk is to the upside. And as we say every week, do the work, endure the pain of gain, and have investment courage.